Hi, welcome to La Tour de Finance, Italy, autumn 2023. We're in Abruzzo today at the beautiful Castello Semivicoli in the cantina, as you can see. What a better place to kick off the interviews with our experts who've come to talk to people living in the area. We've got today with me Joy Callender here and Lorraine Redaway. They're from RBC Brewin Dolphin Asset Managers to talk about world markets, geopolitical events, and how things affect our money. I've prepared some simple questions for them, things that most of you are asking me these days, and that they are probably much better, have a lot more knowledge and a much better place to answer the questions for you. So I thought I'd do these interviews so that they can bring their expert knowledge to you, and you can hear right from the horse's mouth exactly what's going on in the world today and how it affects you from a financial perspective. So without further ado, I'm going to crack on with the questions and let them do the talking. And I don't know which one of you would like to answer the first one, but anyway, I will just crack off with it. But so the one question that I'm asked at the moment quite a lot is, why shouldn't I invest in bank accounts right now? It's not a question. Naturally, I should turn that question around. Why should I put my money in the bank account instead of investing, given the volatility in the markets that we've seen over the last few years?
Well, I can understand the question because we have had a very volatile performance over the last 2 years. After COVID, there was a remarkable recovery in stock markets, and then last year, I suppose to everybody's surprise, there was quite a big sell-off. We've seen some recovery this year, but the really big thing is that interest rates have changed. The whole cycle has turned from zero rates to now substantial increases. In the UK, the base rate is currently 5.25%, and within the Eurozone, it's up to 4%. And on the surface, they seem like very attractive rates.
They do.
However, there are a couple of issues related to that. I think most banks probably aren't paying a deposit rate similar to that level, and that's an issue. But the more important thing is, where do deposit rates stand next to inflation? In the UK, inflation is running at approximately, core CPI is approximately 6.25%. It's a bit lower in Europe at just under 6%, but it's highly unlikely that you can get bank to pay in deposit interest at anywhere like that rate. And so the problem is that if you do lock up your money for a prolonged period, you risk seeing a decline in the purchasing power or the real value of your cash. And there's a very interesting statistic that if you have 100,000 as an example locked up on deposit and it's earning 2% less than the rate of inflation, over 10 years, the real purchasing power is eroded to 80,000. So it's a significant decline in the value of money.
Right.
Yes, and I mean, I'd add to that at RBC Brewin Dolphin, we would always advocate that a client has at least 6 months of required income on cash, and clearly there is some opportunity to actually have higher than usual returns on that 6 months deposit money. But over the long term, Gareth, what we've seen is that the only way to actually get a return above that inflationary figure that Joy was talking about is to invest some of your, or a reasonable percentage of your portfolio, dependent upon your risk, in equities.
Just a quick side question, but so you mentioned these interest rates that you were talking about. I'm assuming you mentioned lock money up. So I'm assuming that the rates that you're quoting are not the rates that you're going to get on your deposit account, or you're going to have to be putting money away in a sort of a term deposit for 2-3 years or whatever. I'm locking it up for that.
And those rates that I quoted are the central bank rates for both the Eurozone and the UK, but most banks won't give you a rate of interest like that. You get the occasional one where you do have to lock up your money for quite a protracted term. But the issue with that is that the whole investment climate could change and you're locked in and you can't access it. Or inflation, which has been declining, could change again. We're looking at a big increase in the oil price recently because of the hostilities in Gaza and Israel. So you could suddenly find that it ratchets up again and you're locked in for a prolonged period. So it's difficult to get a decent deposit rate in the banks at present.
Right.
And of course, Gareth, there may be income tax considerations.
Of course,
So you may be getting a headline rate, but that may not be
in fact,
the full
I think
story.
most of these rates they've quoted are kind of gross rates, actually. They're not net, Oh, interesting. I mean, that is a conversation that generally I'm having with clients, and, my sort of explanation is kind of on the same lines. I think it seems attractive on the surface, but actually when you dig a bit deeper, it's probably... Again, I guess it comes down to whether you, as you rightly pointed out, whether you're short-term planning or either medium, long-term planning. I mean, if you just need cash for whatever circumstance, then obviously, cash account at whatever rate it's going to give you is actually needed. But if we're medium to long-term planning, it kind of it doesn't make any sense, really. Okay, great. So, here's a good one. This is one for people who haven't got cash but are already invested. So, we've had almost coming up to 2 years where markets have performed pretty badly, let's be honest. Okay, so should I disinvest? And if I shouldn't disinvest from RBC Brewin Dolphin under your management, Joy, why shouldn't I?
I think my answer is absolutely not. Don't disinvest. For somebody who's an equity investor, there's an old saying that it's time in the markets rather than the timing of entering or exiting. And the major issue is if you took a decision today to disinvest, the problem becomes, when do I reinvest? And any statistics you look at will show that the investors who regularly take cash out of the market with a view to re-entering do not perform as well over the long term. When we sit down with an investor, we talk to them about the difference between risk and volatility, because often the two are confused. Volatility is the major characteristic of stock markets. Markets go up and down. They're very news-driven. They're very subject to sentiment. So there can be a reaction to company-specific news, to the major geopolitical events such as at present, or just the general global economy. But over time, I think it is true that a share price of companies will react to the underlying performance of the profits growth, the revenue growth. So you should a good company should grow its share price over time. So we would talk to people and we risk profile them at the outset of a decision to invest, and depending on their attitude to risk, we will always recommend some exposure to equities. RBC Brewin Dolphin has 6 different mandates, ranging from the lowest risk category, which would have about 20% exposure, up to our risk category 6, which is really an all-equity portfolio. And it's very much what is recommended is very much what the investor can live with. And what we don't want is somebody not being able to sleep at night or ringing in a panic asking us to sell out and disinvest. So that's a big part of the journey. So we always ask investors to take a long-term view, and by that we mean a minimum of 5 years.
Okay. And I would just add to that if you look back even as far as, say, if you go back in history as far as World War II, and during that period of time, the markets have been up 70% of the time. And if we take the COVID year, 2020, we take the global financial crisis, 2009. During those years, investors would have been down circa 30% during the course of that year. Yet both of those years, had the client stuck with it, they would have actually ended up in positive territory. So, as Joy quite rightly points out, you're in it for the long haul, and providing you have a 10-year investment horizon, then you know, it has always played out that the clients will be the winners, but not if they exit.
I mean, if I'm sitting on the side of the client, and because I'm, you know, listening a lot to people and what they're saying, I think the issue that we've seen in the last 2 years is not okay. I think consciously people know that they need to remain invested. I think subconsciously it creates a lot of angst when they don't see markets starting to appreciate after almost, you know, 2 years essentially. And I think that's basically what people are concerned about. You know, what is the future? I think we know because we've got access to all the information, you know, all the statistic analysis, all the historic data, etc. But I think for somebody who's just looking at their balance and it's kind of gone down and it's not coming up very quickly, you know, it creates a lot of stress for a lot of people. So I do like to sort of sit on their side and try and understand where they're coming from as well. But it's interesting because that actually leads nicely on. You talked about risk. Question 3 was, what do we mean by risk? I'll tell you what this is something that I have over the years tried to quantify. I talked to you, Lorraine, about it before this meeting, and I've got my own hypothesis because, you know, we know risk, volatility, you know, how much the stock goes up and down in every 1 year, blah, blah, blah. No, okay, that's the scientific, if you like, explanation. My feeling is that when I speak to people and they say, do I want, you know, and I say, what kind of risk level you are, we can measure that. Their perception of risk is my money going to disappear down a big black hole and then I never see it again? Of course, my sort of retort to that is that, well, that's essentially fraud and scam. I mean, we're not in the business of fraud and scam. So that's not what we're doing. But maybe you could elaborate just a little bit more on actually the meaning of risk. You know, you've talked about it in terms of returns, but sort of, let's say, the scientific investment management, so we can help people understand a bit more.
And I think you've answered the question to a certain extent, because if somebody said to me, what is your definition of risk? The first one that comes to mind is that the fear of losing all my money. And again, I refer back to what we've already talked about. It's a long-term journey. Over time, stock markets will reflect global growth. They'll also reflect company performance and growth in that, but there is huge volatility during that journey. So it's absolutely essential to have a long-term time horizon. And a big part of managing risk is defining the risk tolerance of each investor. And also it's not just their financial objectives, what they feel they see in terms of returns from a portfolio. And you have to take account of changing life circumstances, because somebody who comes into you at 35, 40 years of age can take significantly more risk than somebody of 65, because the 35-year-old is really still in the early stages of their career. They're still earning their income every year, whereas you get to 65, they're retired. So the portfolio becomes more important, because it's probably the income generator. And so we spend a lot of time working out the correct mandate for an individual investor. But there are other risks, because the sort of instinctive response is to jump out of the market if the going gets tough. But if you're out and you put your money on deposit instead, technically it's safe, but there's then the risk that it underperforms inflation and the value of the cash is eroded away. And there's other risks. If you are invested, it's important that you keep an eye on performance and regularly reevaluate whether the portfolio is the correct fit for your life circumstances. If you're in an underperforming portfolio, which can happen, there's fund managers have a good period and maybe they lose a good fund manager and things turn around a bit. If the costs are high, that can eat away at the performance. So there's lots of other risks, but I think the biggest one is the fear of permanent loss of money.
And I think just picking up on what Joy was saying, at RBC Brewin Dolphin, we follow a very clearly defined process. So we work with Oxford Risk and we look at clients between levels 1 to 6. What we mean by risk is how much volatility can they actually prepared to live with? Are they prepared to live with? So as Joy quite rightly pointed out, if you're 65, then perhaps, you know, your loss is not up to 15% a year, it may be 5% or 3%, and therefore we will adjust the portfolios to actually reflect that. But let's just make it clear that equity investment does involve volatility, and that is what will drive the performance ultimately. It doesn't come without volatility, but volatility can be your friend because it is driving your returns. So
it's interesting. The whole idea of volatility for me is quite interesting because I find that probably people have a much higher tolerance to volatility in their equity prices or whatever asset it is than they think. And I'll give you a perfect example. So riding through the financial crisis, 2008, 2009, riding through COVID, I saw quite dramatic drops in. COVID's probably the best example to give because it was a period when people's attention was diverted elsewhere completely. You know, we're all worried about being at home, whether, you know, when we were going to get the vaccine and all these kind of issues, of course, markets fell quite a bit during that time. And what I noticed was that because people's attention was diverted, that most people's accounts fell quite significantly, but then recovered quite quickly as well. And nobody really made much noise about that. And so it's interesting that I think the volatility in a lot of cases is whether you're actually consciously aware of it happening or whether you're not. And actually discussions with clients afterwards saying your account dropped this amount during this time, they're like, oh, really? Oh, I had no idea. You know, so whilst I don't obviously advocate taking an approach of just doing what you want, I think it is very interesting that, you know, the idea of conscious awareness of this factor.
I'd say I noticed that too throughout that period. And I think what's been interesting, because I've been in the business for investment management for a long time, and what's been noticeable really since the end of the financial crisis, where we've had sell-offs, they've tended to be quite dramatic, but quite short-lived. And to me, there's an element that people maybe have learned from some of the lessons of the financial crisis, that exiting the market when it's fallen 40% is an absolute disaster, because the chance of recovering your losses are diminished. Whereas if you can ride out that volatility and stay invested, you do get the return. But certainly COVID was surprising because we saw this sudden 30% drop, and really as soon as people became conscious that we were going to survive, that we could adapt to different conditions from working from home, then the market began to recover. But the market is a discounting mechanism, so it's forecasting or estimating in advance what's going to happen.
Sure.
So which leads me well on to my next question, because I mean, I read a lot about potential recession around the world really right now. I don't think it's all. I mean, there's obviously talk. The main obviously player in that is probably the USA. You know, to what degree is the USA going to go into a recession? And to what degree, I guess, do you think this is going to have an impact on equities in the, let's say, short and medium term?
Well, it's always, nobody can predict. I'll start by saying that. But what's been very interesting about stock market performance since COVID, say, in 2020, we had that dramatic fall off, then a prolonged recovery, and we had amazing returns, over 20% during 2021 as the global economy began to emerge from COVID. But then the central banks changed their stance on monetary policy following an uptick in inflation. Initially, I think everybody thought it was just caused by a dislocation in terms of logistics and because of the cessation of any manufacturing, that there was pent-up demand for goods. But it's soon that inflation within the goods sector soon moved out into energy, and that was very much driven by the onset of the Russian-Ukrainian conflict. And then it's moved on into services, and interestingly into the whole labour market, where there have been wage demands for the first time in maybe 10 plus years. So central banks reacted very quickly, and they've moved the interest rates far higher than any of the expectations going into 2022. So effectively what happened was the market, which does discount future news, really they anticipated a recession coming into this year because of the speed and the magnitude of interest rate increases. But surprisingly, the global economy has held up quite well. We do see and are seeing pockets of weakness, and I do think the biggest impact of higher interest rates has probably been on the housing market because mortgage rates shot up. And we've seen a slowdown in construction, probably certainly in the US, and maybe to a lesser extent in Europe, but it's still there. But despite all of that, the stock markets have seen a recovery this year. They're up about 10%, the global index is up about 10% or so this year. And I think that's been because despite all the bad news, things have actually held up quite well. And maybe it's because consumers saved and cut debt during COVID and seem to have been a bit more insulated to the interest rate increases this time around. And so we've had a recovery. At the beginning of end of last year, beginning of this year, the expectation was that earnings would drop by maybe 12 to 13%, which would be typical for what we call a normal recession. But so far, earnings have held up quite well. At the end of the half year, they were down about 5%, and most of that was driven by a reverse in the energy sector because oil prices did drop at the beginning of this year. And at this stage, we're expecting mildly positive earnings for this year and quite strong growth for next year. Now, it may be wrong, but I think that's actually helped the performance and the recovery we've seen to date in stock markets. But from here, it's hard to tell because I think the magnitude and the speed of the interest rate increases don't appear to have had a huge impact on consumer spending yet. And there's a little bit of that keeps thinking there has to be a hit at some stage. So maybe this emerging conflict in Israel and Gaza may be the cause of a sell-off later in the year. It's
difficult to know.
You can't predict.
Well, look, you've just answered my last question there, so I'll give you two more questions. This one's a real kind of go for you. So you're active managers, right?
Yeah.
So we all know about the world of passive asset management, the likes of Vanguard, etc., who have their sort of index arrangements. Very, very low cost. So tell me, is active management worth paying for?
Obviously,
are you worth it, Joy?
Absolutely worth paying for. Joking aside, there is a big role for active management. And I think probably the most important thing with active management is that a portfolio can be tailored for the individual.
Sure.
I think with a passive portfolio, as markets go up, the portfolio or the investments will track the market up and track the market back down. And most studies would suggest that investors who have passive portfolios are more jumpy. So if you do see a big sell-off, they're more likely to opt out. I do believe the role of active management, a huge element of that is relationship management. And the active manager can be more objective and, if you like, see through the cycle. So they can encourage the investor to stay invested. There's also the opportunity to choose something that's specifically tailored, but the active manager can maybe see emerging trends in markets and won't be benchmarked, so will take a stance against the benchmark that can deliver extra results.
I mean, I would also add to that we do use passives. So in extremely efficient markets, whether it's, say, US global markets, we will plug and play ETFs into those markets, or if it was, say, gold bullion, still liquid, daily traded, low cost. But there are certain markets, as you know yourself, Gareth, whether that's an emerging market, whether that's a trend, say with AI at the moment, where perhaps we need to actually look to active managers who are specialists in those fields to add that additional overlay of performance for our clients' portfolios. So, you know, and we do believe that actually that active management overlay does result and has proven to result in additional returns for clients. So you may be paying a little bit more, but you're getting more than compensated on the reward side. And just a couple of stock examples that we always point to in this regard. I mean, if you look at the returns of companies such as Microsoft over time, if you look at Visa. So, I mean, in terms of putting that up against the S&P 500, I think you'd be quite astounded at the differences in returns that clients have seen. And whenever we pull out the slides and show them some examples, and of companies as well that they may not have heard of. I mean, those two are fairly well known, and arguably clients could pick those out themselves with a small amount of intel. But then there's others such as Thermo Fisher that again they may not have heard of, and they develop equipment in the biomedical field. So
I think I would add on this as well is that they've on the active side, an important part, going back to one of our other points about volatility, is that it also, passive, as you said, you ride the market up and down. Active, there's an element of being able to sort of squash that volatility somewhat for people who may be subject to, are more anxious about market movements. So obviously it depends on your risk profile, obviously, but
I mean, active managers you mentioned COVID earlier, and certainly, we're able to actually tilt portfolios towards home stocks and perhaps away from leisure industries during that period of time, and that added quite a considerable amount of additional returns for clients.
Okay. Well, I'm going to wrap it up with one last question, which is a real futuristic question for you. In the press at the moment, we're seeing a lot about artificial intelligence, AI. To what degree, in your opinion, do we need to worry about AI encroaching on our daily lives and pushing us out of jobs? We'll be talking to robots in the future through these videos. You see this a lot. Obviously, you do a lot of research into this. Is it going to have such a dramatic impact as it's kind of purported in the press that it will happen?
At this stage, it's very hard to predict exactly what it's going to do. But I sort of think of myself as being a bit like when computers were invented, you get a big leap forward in the positive would be that you get a huge leap forward in productivity, because some of the more mundane, mechanical type tasks can be taken over by AI. But I think there's probably two aspects to this. There's the first, what are the opportunities within the industry? And I think it's going to take a while to know what will be the big winners. Up to now, the standout example is NVIDIA, which is the manufacturer of chips for the companies developing AI techniques. And that's had remarkable performance this year. But it's now on an enormous valuation. It's trading on 135 times price to earnings, which may actually turn out to be correct depending on the future.
Compared with the average on the sort of S&P 500, which is 17 times, to put it into perspective.
Well overvalued.
So it looks absolutely enormous. But so it's hard to tell, and there will be enormous economic and socio-political outcomes from the move towards AI. So I think all that we can do at this stage is monitor what's happening and monitor the companies and look for the potential. But the other question, which is probably more specifically of interest to all of us in this room, is what about the future of the investment management industry? I would have thought that it's a bit more the passive end of the industry that might be impacted. I think in terms of active management, it's hard to see where a computer or artificial intelligence can take over from a human being, because there is a huge part of the role of an investment management is the communication and the relationship with the investor. We've talked about it repeatedly throughout this conversation, and it's the reassurance that when you go through a difficult period in markets, also with new companies or new trends, will AI be able to discern those and choose the winners and losers? So I still think you can't beat the human communication with an investor.
I completely agree. I mean, and certainly from a role as a financial planner, from your side of things, I mean, if you're looking at, say, intergenerational wealth planning, we know that there's certain clients that they don't actually want to follow the natural pattern of succession necessarily. They may have relatives that they don't want to leave their assets to. There may be considerations in retirement and opportunities. So at the moment, we've seen some opportunities in the gilt markets for our clients, especially if they're looking at drawing income. Now, you know, that's something that's happened outside of anything that can be programmed. So I think there are still, you know, the human touch is still very much alive and kicking, and as long as we're on this earth, let's hope that it remains that way, Gary.
I think that is a perfect note on which to leave this interview. I would like to thank you both for making the time and effort to come out here to Abruzzo, again to the Castello Semivicolo. If you ever get a chance to come, it's a beautiful place.
It's absolutely amazing.
And yeah, just really thank you tremendously for coming out, spending the time, talking to people and doing these interviews as well. So thank you.
Pleasure.
Thank you.
We'll wind it up there. Thanks.
Thank you. Thanks, Gary.